Hi, everybody. Welcome to the Alts.co podcast. My name is Brian Flaherty. I'm a writer here on the Alts team. Really excited to be sitting down today with Christine Healey. Christine is a former portfolio manager and the head of private markets at Destiny, which is the company behind the Destiny Tech100 Investment Fund, which we've spoken about a few different times on the newsletter. Before that, she was a senior director at FRGE, which was one of the leading marketplaces for private market shares. Also somebody with deep Wall Street experience. She was an investment banker at Credit Suisse and Jefferies. So somebody with absolute wealth of knowledge in the private market space. Today, Christine is the founder and CEO of HEALEY Pre-IPO, which is a boutique broker firm for private market shares. And yeah, just really excited to have her on. We're going to discuss everything in private market investing. If you've ever been curious about investing in companies like SpaceX or Stripe, this is a conversation you're going to want to listen to. Christine, thank you very much for joining us.
Absolutely. So happy to chat with you.
Yeah. So I figured we just start. I think a lot of people listening in the alts community probably are familiar with private market investing and private shares, but many people may not be. Can you just describe to us just the basic differences? What are private shares and how does it differentiate between private share investing and public share investing?
Absolutely. So at the highest possible level, a private company is not publicly listed. So they're not available for open purchase on, say, a stock exchange. How it works to invest in private companies is you're typically arranging a private transaction with a privately identified buyer or seller, depending on which side of the market you're on. That leads to some of the main differences really between public and private investing, because you're following a bespoke transfer process that's arranged sometimes by a broker, sometimes by the company itself, to match a buyer and seller in a kind of ad hoc bespoke transaction.
So it's not as easy as just going onto my Robinhood account and typing a stock ticker.
No, part of the Destiny mission was to enable people to invest in many cases from their regular brokerage account, where you can look up DXYZ, the ticker, and find Destiny. So that's a big part of the Destiny mission, but a very different product. What Destiny has is a broad mix of private companies that you could buy in one portfolio. But there are other ways in the private markets to buy single companies if you're after that SpaceX or you're after that Stripe or that Discord.
Yeah, so I wanted to talk about Destiny. So as you said, the ticker is DXYZ. In case anybody's not familiar, this fund has had a really interesting ride. I think it initially listed a little over a year ago at this point, and initially after listing, the stock shot up. I think it went up to about $100 a share, and the net asset value, if I remember correctly, of the actual holdings in the fund was about $4 to $5 at the time. So it was like over 1,000% premium at that price. Eventually it went down and moderated for a little while, but did still trade at a premium. I believe after Trump was elected, it went soaring again, which is something obviously I'm curious to discuss with you. But yeah, I'm just really curious. I think that people are familiar with the open-end fund space and especially ETFs. But my understanding was DXYZ was a different sort of fund compared to something like SPY, right?
Yeah, absolutely. So it was very intentional to Sohail Prasad, the founder, and the legal team behind Destiny to structure Destiny in this way. Some of the types of funds out there that are trying in some way to address private tech are falling short in one or more ways. So one popular structure out there is the interval fund, but there's major downsides to that. In an interval fund, your liquidity is severely limited. You can't necessarily sell when you want to. And Destiny was in part conceived with this priority of liquidity, potentially being able to sell just on your regular brokerage account your entire position if you wanted to. And so the ease of buying and selling is something that was achievable with the closed-end fund structure.
Yeah, and I think it's such an interesting trade-off because obviously things like interval funds and tender offer funds have obviously more limited liquidity. At the same time, the great liquidity of something like a closed-end fund can also sometimes lead to those kind of price fluctuations where you see the actual fund price is so high, but the underlying holding price isn't actually shifting in line with that, especially because private markets are not always valued that frequently. So I'm just curious, I'm not sure how much you could speak about, but internally, the team, when you guys were thinking about launching this product, was there a discussion of, hey, we might see a big premium here, people might get pretty excited about it, or was there an expectation that the price of the fund was going to trade roughly in line with the net asset value?
With closed-end funds, there's always the fundamental idea that how it trades could vary from the net asset value. So that's always a possibility, whether up or down. But we also knew that what we were bringing to market through this structure was very different than a lot of other closed-end fund structures had brought to market potentially. There was a bit of an unknown. Destiny was a test of the market in a sense. Our founder has spoken about how there's a discovery process around a product like this, but we are of course always hoping for a really strong start. I think we saw excitement and momentum around Destiny that was probably greater than we ever even thought would happen. And I think to us, that was just a huge signal that what we were working on at Destiny was important, that there was demand for it, and that it meant a lot to people as a means to access these companies that they believe in a lot.
Yeah, and I think that's great. One of the things I wanted to ask you about was this idea of Destiny has fairly consistently traded at a premium above its net asset value. Of course, it's not something you really have to be concerned about if you're buying a traditional ETF or a stock. But to me, it speaks to this strong retail demand for these private market shares. It's not always that easy to access them, therefore translates into this premium. Do you think that reading is right, or is there a different way to understand the premium?
Yeah, I think there's a few elements. There's the fact that there's a huge access issue in terms of private equity and who's actually allowed to participate. So in normal private transactions of single companies, you have to be an accredited investor, meaning high net worth or high income or a few other rigid requirements. So that can really block out a lot of everyday people from having a stake in some of these high growth companies. So that access issue was part of what Destiny was founded to try and solve, to be able to give everyday people the ability to invest in these companies from their brokerage account and with no real minimum size. So you could put in $50, you could put in $100. So you didn't need to be a millionaire. You didn't need to be putting in 500K to be able to have a stake. So I think that there's a real access issue, which has been highlighted by how much everyday investors, I think, have flocked to the Destiny product at scale. The second thing is, I think people really want to own these companies and they're not satisfied with some of the maybe more vanilla or just the different investment products on the market. And they're looking for something that represents the high growth category. And on an individual company basis, that represents names like SpaceX, names like Stripe, names that they get really excited about, that people see as the future. And so there's something beyond just a financial stake that is powerful about owning a piece of a company that you think is changing the world and advancing human progress.
Yeah, no, I think it's a fantastic point, because if you look at the early internet revolution, you're talking about companies like Google or Facebook, you were able to buy stock in those companies at a relatively young age, right? And people were using that every single day. Now, companies like Perplexity or OpenAI, ChatGPT, it's hard sometimes to invest in the companies that you are actually using every single day. And I guess I'd be curious from your perspective. A lot of the data I've seen seems to indicate that there is growth now locked up in the private markets because companies are not IPOing as early on. I was just wondering if you could speak to that, this idea that perhaps companies are just IPOing later.
Yeah, I think it's been a trend for quite a few years now of companies that could go public by any traditional standard of the past, choosing not to, or choosing to delay it sometimes 5-10 years or longer. You have companies like Reddit, which were almost 20 when they IPO'd, and some extreme examples. And I think that you have some companies, SpaceX being one of them, that are modeling this idea of staying private for a really long time, keeping tight control over the company, tight control of shares even, and staying laser focused on a mission. So you have certain iconic founders saying, I don't want to go public until I've achieved this moonshot goal of my company. And I'm worried that any burdens of being public, quarterly disclosures to the public, whatever it might be, might ultimately detract from our mission. And so they're choosing to keep building privately when in some cases they could be $1 billion, $10 billion, $100 billion, $300 billion companies. And so it's really interesting. And I personally expect that to continue. And yeah, we can talk about that for hours. I'm sure it's an interesting topic. But as a result of that, like I mentioned, you could have companies that have had so much of their growth stage, sometimes up to hundreds of billions of dollars, completely on the private market. And so all that growth can only be captured by the investors that can invest while the company is private. And that is why I find private market investing so interesting and so important, really, because if a huge amount of the growth of a company is before it even reaches the hands of public investors, then that's a whole lot of value to be otherwise kept out of your hands or kept out of the hands of most people.
Yeah. So it's one thing, I'm glad you brought it up because I really am curious about this idea of a lot of, I think, private companies have an incentive they want to have more like strict control of who's allowed to invest in their company. And I think it's not always a negative thing, right? Because for instance, if you run a family business, then it's probably not in your interest for anybody on the street to be able to buy it and to be able to have an influence in how you run your company. So I think there is some understanding that companies on the private market want to have some discretion over who can and can't buy their shares. At the same time, there's always a tension with if a company is saying, hey, we're going to kind of limit the people that can buy our shares or limit that access. At the same time, it's going to make it harder for individuals to invest in these companies. And it's just a really interesting tension I've noticed in the private markets is this idea of companies wanting to have greater control and investors wanting to have greater access. Do you have any thoughts on that tension or navigating it?
Yeah, I think it's a huge tension. I think it's a tension that is going to persist the more companies try and keep control. I feel like companies in the pre-IPO space are diverging into two camps. There's companies that are maybe becoming more open to the idea of liquidity. There's great companies like Discord that do allow direct transfers in an organized kind of routine fashion, and numerous others. And then there's the second camp of companies that are getting more strict, more controlling, adding restrictions and so on. So there is quite a divide there. But the reality is, if you're an early investor or an early employee at some of these companies that have become unicorns or decacorns, it's a very real and very pervasive reality for a lot of these people that they have money on paper that they can't use to buy a house. They can't use to fund their next business venture. They just can't use because it's locked up in illiquid shares. And so if you imagine being that employee at this company that you've poured, in some cases, 10 plus years into building a company off the ground into a unicorn, that's a very difficult tension to grapple with. And so my personal opinion is that for the future of these innovative, pioneering companies that have grand goals, they will need the best talent. They will need the best investors. They will need to have the best resources possible. And so I think they will need to empower their employees and investors with greater liquidity, because otherwise it's gonna impact how employees and investors allocate their time and their capital.
That's a fascinating point. If you're a, for instance, AI engineer right now, and there's one company that has very liquid access to the shares that they're compensating you with, the other that doesn't, that's going to have a real impact, right, on the company that you want to work for. But with that in mind, I think there is this kind of interesting dichotomy where we talk about a lot of companies are taking longer to go public, and that is increasing interest in the private market because so many of these innovative companies are still have yet to IPO. At the same time, if you talk to investors in private market shares, and outside of the initial VC or employee investors, but maybe just an individual high net worth investor who's now buying shares of SpaceX, there's also an interesting tension with them in that if the company never goes public, there's not really that traditional liquidity event for them to actually cash out. And I'm just curious, because I'm sure you talk to buyers and sellers all the time, is that sort of a hurdle or a tension for buyers?
It can be, and then it's something that we can educate them about. So generally, when you're buying shares in one of these private deals, you continue to hold until there is some sort of exit event. And so that could be an acquisition, that could be an IPO, that could potentially be some sort of bankruptcy. We just don't know. But there's also the reality that the more the secondary market activates and the more buyers and sellers come to market, even though it's an illiquid asset class, an active secondary market for a given company does add a bit more liquidity than you would otherwise have. And so there's potentially the chance that if you hold for, say, several years, the company may not be public yet. You might be able to consider reselling on the secondary market to another private buyer. So there are regulations and rules around this. You have to buy these private shares with the intention of holding long term. So typically, to be conservative, you want to hold for at least 6 months, but really the longer the better. You have to buy to hold long term. But should a liquidity need come up down the road, let's say a few years from now, there may be the opportunity to resell if there's another private buyer looking to buy what you're looking to resell. And so I think that's a really interesting angle too, which adds a whole dimension to private share trading. Because you would, if you are buying a private asset, you might want to look into how active is the market for this company? How active could the market for this company be down the road? How easy would this be to potentially resell down the road? So for example, if you buy an SPV investment that's 0-0 and doesn't have management fees and carry, all things remaining equal, that tends to be easier to resell if you needed to in future than a stake that you might hold that has fees and carry attached to it. So I think it's an interesting dynamic that is really better to think about up front when you're getting into business with, say, an SPV manager, just to leave that option open down the road.
Yeah, so on the idea of liquidity, I think some of the data that I've seen is that a lot of the private share liquidity is concentrated in some of the really big names. I think that kind of makes sense. People are very familiar with names like Stripe and SpaceX. They're very excited to invest in them. Some of the smaller companies that maybe people have not heard of so much, but are still very successful, might have a tougher time getting liquidity. I was just wondering if you could offer us any insight. Was that kind of match the dynamic that maybe some of the big names, a lot of the liquidity is concentrated there, or is it more spread throughout the market?
Yeah, absolutely. I think there is real concentration at the moment, and there has been for several years now. So after 2021, when the whole tech market got a big shock in 22 and 23, there was, pretty notable concentration in a smaller number of what were considered almost blue chip pre-IPO companies. I think with the markets as turbulent as they currently are and as volatile, I personally predict that we might perhaps see that extreme concentration happening again in the coming months or over the next year. I find that when there's volatility, that's when the concentration tends to amplify. So I would predict that we could see that again, and we could see hyper concentration of activity among a smaller number of companies. Now, I think also with volatility, there may be more sellers coming to market in a number of names, trying to de-risk some of their holdings while they can, but just having a bunch of sellers or just having a bunch of buyers is a one-sided market unless there's another, and the other side of the deal is also there. So where there's real activity, where there's deals being closed, is really hyper concentrated in a small number of issuers.
So that's really interesting. There's a couple different things that I definitely want to dive into. And one of them is, it almost sounds like it's odd to talk about in a market like private share investing, right? Which is inherently going to be a little bit more uncertain or unfamiliar with people than public share investing. But it almost sounds like there's flight to quality there, where people are running to these names that they actually know about in a volatile environment.
Yeah, I love using the term flight to quality for this. I think it's exactly what that is. And of course, quality is subjective, but there are different ways that I see my clients and I see the broader market managing risk. One way to manage risk is to diversify, to buy more different types of investments and to spread out your money. That's a reasonable way to manage risk. How a lot of investors in this market manage risk is that flight to quality. They will cut down the list of companies they're looking for to just the ones where they have highest conviction. Yeah, I think different investors have different attitudes towards risk, but the flight to quality is a phenomenon that's very strongly seen in this market.
Yeah. And I know you mentioned that there's more interest with buyers and sellers during volatile periods. I think there is this reputation for private market investing that if you want to have a very generous interpretation, that private markets are less subject to the technical factors and the price distortions that can happen in public markets. If you want to have a pessimistic interpretation, it's that a lot of these shares are not valued as frequently, which I know increased liquidity in the secondary market is going to help improve, hopefully. But yeah, I was wondering if you could speak to that. Historically, I'll be honest, I have been a little bit skeptical. It says, okay, some of these lower volatility figures, to what extent is this just not really marking these assets to market as frequently? I was just wondering if you could speak to that, to the extent that private markets can be a true buffer in a volatile environment versus just not looking at it and hoping for the best.
I think there's huge differences between the public and the private markets. One of those differences is in data access. So it's extremely common not to have the latest company financial data when you're doing a pre-IPO deal. There's, of course, far less disclosures than you would have compared to if you were investing in a company in the public market. That, in my opinion, is one of the biggest adjustments that investors have when they're getting started in pre-IPO and they come from more of a public investing background. We wish it were different, but that just tends to be the case. There are some deals where you might get access to a data room or a recent financial deck or a diligence call with the company or with a VC that knows the company well, but it's really few and far between. And often more institutional deals get access to that. So there is still, unfortunately, a real disparity in the leverage and the access that super large deal sizes have in the pre-IPO market. What a $5 million, $20 million institutional buyer could maybe get in terms of company data or data room compared to what an individual investing $100,000 might get. So that's the biggest, I think, adjustment going into the private markets. I do think that data sources specifically tailored to the private markets are getting better and better, and there's more and more smart people working on it, like my friends at Caplight. And that's really exciting to see. So where we may not have the best transparency on fundamentals of certain companies, we can look almost in a more technical way at recent closed secondary transaction pricing momentum. We can look at recent tender pricing, 409A pricing, primary round pricing, whatever it might be, in a more nuanced way than was possible in the past. At the same time, a lot of that pricing is so circumstantial because of all the different types of deals that are done in this market, all the different sizes. And so while there's more and more data, it can be a little bit complicated to interpret at times. And so that's, I think there's still many more exciting advancements in terms of private market data from here.
Yeah, and I think that's a fantastic point on the idea of what data a super high institutional buyer might have access to versus somebody who's on the more retail side of things. I was curious at that. I wanted to return to Destiny a little bit because I think that a lot of sort of retail style investors probably will access this market through some sort of listed instrument or an interval fund. I'll be honest that in the wake of Destiny's launch and seeing that it had this premium, I was a little bit surprised that more asset managers weren't coming to market with these sort of public listed shares. Because I would think about, okay, if I have a private share that's worth $10 in my own portfolio, but then I can list it and it has a premium of an extra $5, it almost seems like printing money from an asset manager's perspective. And I was just curious for your thoughts on, do you think that we'll see more of these public listed structures? Do you think that it's going to be more on the interval side of things, which obviously trade at NAV? Or what do you think the future of a private fund structure looks like in the wake of Destiny?